Inflation is reaccelerating just as AI equities hit fresh highs, forcing investors to reassess how long today's rally can withstand a higher yield regime. Welcome to vTalkInsight, Equity Pulse Daily for May 14th, 2026, where we connect the macro shock, the bond market repricing, and the AI trade that now dominates global equity performance. U.S. inflation has reaccelerated in a way that is hard for equities to ignore. Producer prices in April jumped by about 1.4% on the month and roughly 6% year-on-year, the strongest monthly gain since early March 1, 2022, while consumer prices have also surprised to the upside. Behind those prints sits a powerful energy shock. War-related disruptions through the Strait of Hormuz have pushed headline inflation to around 6% and core to just above 5%. Well in excess of the Federal Reserve's 2% target and reinforcing a stagflation narrative of higher prices alongside pressured growth. Bond markets have reacted decisively. 10-year Treasury yields are trading near 4.5%, 30-year yields sit well above 5%, and shorter maturities around 2 years are now above the policy rate, signaling that markets have largely removed any near-term easing bias and are starting to price the risk of further tightening. Policy communication risk is rising at the same time. Kevin Warsh is expected to become the next Fed chair, and his preference to avoid detailed forward guidance could mean more market sensitivity to each data release and a higher probability of volatility spikes around meetings and speeches. For equities, this yield repricing is a direct challenge to today's valuations. Long-dated bonds now offer income in the 5 to 6% area, corporate credit spreads remain tight, and retail investors still hold relatively little fixed income, so any further inflation surprises or policy hawkishness could accelerate a rotation toward bonds at the margin even as the VIX sits below 20, signaling only moderate equity stress so far. Set against the macro headwind is an earnings cycle that remains remarkably strong. Across the S&P 500, the median earnings surprise is running in the low teens, with close to 9 in 10 companies beating expectations, and overall index earnings continuing to grow at a pace that keeps pushing profit forecasts higher. That strength is visible in macro aggregates as well. Net income for S&P 500 companies has climbed to roughly 9% of U.S. GDP, compared with historical peaks nearer 6%, which supports today's equity levels but also raises questions about how durable current margins are in an environment of rising wages, tariffs, and input costs. Wall Street is leaning into this profit resilience. Morgan Stanley has lifted its year-end S&P 500 target to around 8,000, and other major banks have also raised their views, even as the top 10 stocks now account for roughly 40% of the index, making overall performance heavily dependent on a small cohort of mega caps. Positioning data suggests the rally is not yet overcrowded. Systematic and discretionary equity allocations are not stretched, and high-yield credit spreads remain close to record tights, indicating ongoing risk appetite and confidence in corporate balance sheets despite higher government bond yields and rising concerns about fiscal deficits. The tension is that higher discount rates and elevated profits are colliding. If inflation remains sticky and the Fed signals a firmer tightening bias, the market may begin to question how long earnings can defy macro gravity, particularly as hyperscalers fund over $1 trillion of annual capital expenditure with balance sheets that have already seen around $100 billion of net cash erosion over 2 years. The clearest manifestation of this tension is in technology and semiconductors. AI and chip stocks have gone near vertical, with the Philadelphia Semiconductor Index up more than 60% and options markets showing record call buying, heavy gamma hedging, and a sharp jump in volatility skew, all pointing to increasingly speculative behavior layered on top of genuine earnings growth. Nvidia sits squarely at the intersection of this story. The company already supplies the vast majority of advanced AI chips globally, and its shares have pushed to all-time highs as Chief Executive Jensen Huang joins a U.S. delegation to China, fueling hopes for some easing of export frictions, even though officials are signaling that national security concerns limit the scope for any major breakthrough. The broader AI infrastructure complex is echoing that enthusiasm. Cisco shares jumped by more than 10% after hours on stronger than expected orders from hyperscalers, upbeat guidance for the coming quarter, and a restructuring plan that channels more capital into AI, security, and silicon, while new names like Cerebra's line up large IPOs backed by multi-billion-dollar order books and sizable compute commitments from models providers, such as OpenAI. Private markets are, if anything, even more aggressive. Anthropic is reportedly seeking to raise at least $30 billion at a valuation that would exceed the combined market value of Tencent and Alibaba, and SoftBank has booked tens of billions of paper gains on its OpenAI exposure through the Vision Fund, helping its full-year profit to beat expectations and prompting plans to increase that stake further. Yet there are clear fault lines under the surface. Samsung faces rising strike risk at its memory plants just as demand for AI hardware accelerates, while Micron and other memory names are rebounding strongly from intraday sell-offs on the back of upgraded earnings estimates and still modest forward earnings multiples. And companies like Marathon Digital Holdings are pivoting from legacy activities into leasing more than 1 gigawatt of data center capacity as power availability becomes the main bottleneck for AI build-out. The other axis shaping equities today is the energy and geopolitical shock. Satellite data show Iranian crude exports via Karg Island have effectively stalled for several days. Storage tanks are filling, and global inventories are being drawn down at a record pace, leaving Brent still above $100 even after a modest pullback and keeping an inflation premium embedded in macro forecasts. Those disruptions are cascading through supply chains. Hapag-Lloyd is absorbing roughly $250 million a month in extra fuel costs as ships reroute around danger zones in the Gulf and the Red Sea. Freight rates are rising into the peak season, and even if key waterways reopen soon, industry estimates suggest it could take several months for capacity and schedules to normalize, squeezing margins across global trade. In Europe, that backdrop is driving distinct sector rotation. Regional indices are being led by basic resources, energy, and telecoms, while travel and leisure lag on higher fuel and security costs, and Siemens has highlighted how geopolitical uncertainty, volatile oil and gas prices, and delayed Middle East investment decisions are weighing on visibility even as it reports double-digit order growth and launches a €6 billion share buyback. Security tensions are also reshaping defense and strategic industries. Taiwan has approved around $25 billion of supplemental defense spending, China is accelerating missile production, and in upcoming U.S.-China talks both sides are expected to focus on stability while using levers such as rare earth exports, aircraft purchases for Boeing, and potential adjustments to AI chip controls as bargaining chips. Layered on top is a complex rates and politics mix. UK gilt yields have surged to levels last seen in the late 1990s amid fiscal concerns and political turmoil, even as some see the current fixed income environment as offering the most attractive income in decades, and at the stock level Ford has rallied on expectations that its energy storage business could win large supply deals, showing how the energy transition theme is intersecting with grid resilience and, indirectly, with the power needs of AI infrastructure. Stepping back, global equities are being pulled between a powerful AI and earnings engine on one side and a resurgent inflation and yield shock on the other, all against a backdrop of energy disruptions and geopolitical complexity. The key tensions now are whether strong and still broadening corporate profits can offset higher discount rates, how far the AI and semiconductor rally can run before positioning and valuations trigger a reset, and whether upcoming U.S.-China talks relieve or compound pressure around chips, trade, and rare earths. From here, inflation prints, Fed messaging under a new chair, the path of oil and shipping disruptions, and company guidance from AI and energy-linked names are likely to be the main catalysts for any shift in equity leadership, market breadth, or volatility. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.